The 5-year transformer lead time. The lead time for a single high-voltage transformer has hit 260 weeks, officially outlasting the useful life of the AI chips it is built to support. While big tech PR focuses on model parameters and trillion-parameter scales, the reality is sitting in a manufacturing backlog in rural Georgia and Ohio. Microsoft and Google cannot buy their way out of a physics problem with venture capital. If you cannot step down the voltage from a transmission line, your $10 billion compute cluster is just a very expensive collection of paperweights. This delay is the first hard ceiling on AI growth that scaling laws cannot solve. The interconnection queue nightmare. There are currently over 600 gigawatts of generation and storage capacity waiting in interconnection queues across the United States. To put that in perspective, that is double the entire current capacity of the U.S. power grid. The narrative says we are in a chip war, but the actual P&L shows a permit war. Utility companies are not incentivized to move at the speed of a software release cycle. They operate on 20-year depreciation schedules and glacial regulatory approvals. This friction creates a massive disconnect between the projected AI revenue in analyst decks and the physical ability to plug the servers into the wall. Utility monopolies versus hyperscale speed. During the April 2026 earnings calls, the tension between data center operators and regulated utilities reached a breaking point. Hyperscalers want power delivered in 18 months, but the utility companies are reporting that their grid-thickening projects won't be online until 2030. This is a clash of business models. One relies on quarterly growth and the other on guaranteed rates of return approved by state commissions. When Amazon buys a nuclear-powered data center site, they are not just buying energy. They are bypassing the grid entirely because they have lost faith in the public utility's ability to execute. This move toward off-grid, behind-the-meter generation is a desperate attempt to decouple tech growth from crumbling infrastructure. The copper supply ceiling. An AI data center requires roughly 4 times the copper of a traditional facility, and the global supply is not keeping up. We are looking at a projected 10 million ton shortfall by the end of the decade. This is why the narrative of AI being a high-margin software business is a lie. It is becoming a heavy industry business. When your primary growth constraints are the price of red metal and the availability of electrical engineers, your margins start to look less like NVIDIA and more like United States Steel. The asset-heavy reality. The move toward specialized energy deals and private substations proves that the AI era has officially hit a physical wall. By analyzing the massive shift in CapEx from silicon toward power generation and copper procurement, we can see that big tech is no longer just a software play. It is a massive bet on industrial infrastructure. The 5-year transformer lead times and the 2,000 gigawatt interconnection queue indicate that compute is no longer the scarcest resource. Capacity is. This transformation means the real winners in this cycle will not be the companies with the most elegant code, but the companies with the most aggressive land use permits and the largest private power plants. The signal under the noise is clear. Margins will compress as the cost of physical reality finally catches up to the digital hype. Watch the FERC regulatory filings this July for the final word on co-location rights. That will determine which data centers actually go live and which remain ghost projects on a spreadsheet. Subscribe for more